Do you think rates have caught up with expectations sufficiently in the short term?
I think there's still potentially room for some more. I mean, obviously, these things never move in a straight line. There's always some consolidation. But I think the bias is still rates higher. The bias is still yields higher. You know, the inflation data this week, CPI, PPI, keeping the Fed under pressure, but also the labor market data, right? We have unemployment plummeting and wages at multi-decade highs. You know, today we got the Atlanta Fed wage tracker up at this highest level since 2002. And it's the combination of this very tight labor market, strength in wages, with the more persistent elevated inflation that keeps a lot of pressure on the
Fed. In terms of what could be a trigger for yields to surge, do you think it's rate hikes or the end of bond buying? Which is more relevant?
I think the end of bond buying is pretty completely, discounted by now. That's not the big deal. But QT, actual balance sheet roll-off reduction, that's a much bigger deal. Clearly the things that the market is wrestling with right now is, how many times is the Fed going to hike this year? It's pretty clear they're going to be starting in March. And when will they kick in that QT? And how aggressive will it be? Because, of course, if the market's having to digest at the same time, we think 4 rate hikes this year and pretty aggressive QT, pretty aggressive balance sheet reduction. That is a lot for the market to digest.
Chicago Fed President Charlie Evans on the tape just a few minutes ago, and maybe coincided with this fall we're seeing in the markets, Krishna, saying the balance sheet is, quote, very large. The Fed will likely start shrinking it sooner than later following rate increase. He's about as dovish as it gets lately. And he's talking about sooner rather than later on balance sheet shrinking. What happens to the economy when that starts?
Well, first of all, you're absolutely right that the big guns on the dovish side, Brainerd, Daly, Evans, have all swung in a big way towards this new focus on inflation. So right now, there just aren't really any doves left. It's a focus on the idea, I think Charlie used the phrase, that policy is not well positioned right now. And here's the problem, right? The Fed has kept its pedal to the metal until they've got unemployment down below 4 and falling fast. Inflation obviously is well above their target. And the gap between where they are right now and where they might find a neutral-ish policy setting is big, right? We're still at emergency era settings. 0 rates, 9 trillion-ish balance sheet. And even if you think that neutral setting isn't too high, maybe it's 2% on Fed funds, maybe it's a 6 trillion balance sheet, and you get there over, say, 4 years or so. That is, to coin a phrase from Powell this week, a long road back to normal. And so as his data comes through, the Fed is under more and more pressure to close that gap back to normal faster, even if they're not yet convinced that they're going to actually have to hit the brakes at any point in time.
So Krishna, earlier this week, Jamie Dimon said he thought there could be 4 or even more rate hikes next year, and that wouldn't derail the economy because, of course, it's only 1% or whatever in total as opposed to rates getting up to 2, 3, 4. Do you agree that level wouldn't derail the economy?
So, yes, with a very important caveat, right? And the caveat is this. There's a tension in thinking about these things between the delta, the change, and the level. So Jamie's exactly right that if the Fed hikes 4 times this year, which is my expectation, and starts the balance sheet runoff, in principle, at the end of this year, funds rate of 1%, a balance sheet that's, say 300, 400, 500 billion off its peaks, so still around 8.5 trillion or slightly less. That's still a supportive, still a stimulative set of policy setting. The caveat is the delta, the change. That's a lot for the market to digest. 4 hikes plus the QT. It's really hard to pin down how much tightening you get out of QT, but it could easily be 1 or 2 hikes worth just in this year alone or more. So there's a lot for the market to digest in terms of that level. And while in your kind of classic macro models, all these things move smoothly and linearly, the risk, of course, is that at some point in the real world, you get more of a nonlinear tightening of financial conditions that really starts to slow things down.
And they don't seem worried about that yet, at least with the market sell-offs that we've seen lately. Krishna, thank you for joining us. Krishna Guha.
My pleasure. Take care.
We've got a newsmaking interview about this very topic, Fed policy and inflation, next hour on the show. We're going to be joined by Philadelphia Fed President Patrick Harker, making news in a speech. He'll talk to us on Closing Bell. Up next on the show, though, much more on this big NASDAQ sell-off. We're looking at session lows right now, down 2%. The mega caps getting hit hard, as Wilfred mentioned.